Yo, what is good, my boys? Sarantre is back with another episode, and I saw a lot of comments on my other video that I made about the PB trading mech model of you guys asking me to make a video on the PB trading discretion model. So here we are, and without further ado, let's get into it. So first off, I'm about to put you guys on some source. Don't ask me how I got this, but this is Blake's actual document that he uses as his trading plan, and this is his 2024 trading plan because that is when he came up with this model. So first thing first, the mech model that I already made a video on and the discretionary model are two very similar trading models, the key difference being the discretion involved in it. Whereas with the mech model, you are specifically waiting for a higher time frame PDA rate to get swept, a reaction of it with the highest time frame inversion leg, always targeting an unfilled 5 or 15 minute gap, stops always at the lows. Whereas the discretion model, it's a very similar trading model, however, it's a little bit more adaptable because obviously, you know, we might sweep a perfect PDA, perfect liquidity sweep, everything's aligned with bias, but you know, there's no unfilled 5 minute gap, or there's no, maybe it wasn't a London low sweep or something like that. Maybe it wasn't an intermediate term high or low, right? And that's where the discretion model comes in. Or maybe we inverse it too far where you can't really afford to put your stops at the lows anymore. And now, because of that, if you did, you would have 120 point stops. So instead, we're going to use the discretion so that we can kind of find a way to still be in this trade if it's a valid entry without us having to stick to such a mechanical model. So first things first, this trading idea is exactly the same as the mech model. It is based on the fact that the market moves for three reasons. It's either looking to take out buy side or sell side liquidity, looking to rebalance inefficiencies being fair value gaps, order blocks, and that's pretty much it. Fair value gaps and order blocks, and I guess rejection blocks, but don't even worry about that. And if you guys don't fully understand what a fair value gap is, make sure to go check out this video right here that I made. Very, very important video, the only one you'll ever need to watch on fair value gaps, and that is literally the most important concept within ICT trading. So make sure that you guys, you know, have watched that video. But yeah, so it's always going to be looking to take out sell side or buy side liquidity being highs and lows, rebalancing inefficiencies, or us rebalancing towards equilibrium. I'm going to explain equilibrium for you guys quickly. I've got a drawing here for you. Very, very simple concept. Bang. Okay, right here we can see, I'm just going to take off my GAN box. Here we can see we have a swing low right here. This is our swing low for argument's sake, and this is our swing high for argument's sake. Okay, and all equilibrium is going to be is us taking out our fib tool or our GAN box, anything that gives you standard deviation levels, and I guess levels of where price is within the range. And as we can see here, we have on my GAN box, but I can also open fib for the guys who use fib. Here I'm going to put my fib tool at the low and pull this to the high, and here we can see 0.5 right there. That is equilibrium. 0.5, 50% of the range. So simple, there's nothing more to it than that. That's all it is. That 50% of the range, when price pushes high, makes a low, makes a high, and then corrects 50% of it, that level right there, this 50% level, that is what is referred to in trading as equilibrium. And it's not only a good zone that price is likely to draw to before going higher or lower, but it's also a good zone for us to take trades from, because if price rejects from there, combining that maybe with a fair value gap, we can be sure that price is likely to then continue into that direction. And this goes hand in hand with something else that we're about to get into. But Blake also is very strong and very adamant about understanding what side of the curve we're on with the market maker buy and sell model, and that's what I'm going to get into just now. But yeah, that's what equilibrium is. And the nice part about all these concepts is that we are always looking to be on the right side of the market. So whether it's a fair value gap, an order block, equilibrium, those levels generally shouldn't be getting respected the way we want them to if we're on the wrong side of the curve, meaning that it's a lot harder for us to get faked out of setups if we are bullish and we're taking longs, because bearish setups will tend not to work. And if they do work, we can just filter them out and only take the high probability bullish setups that we want in this example. Getting into it, so those are the 3 reasons the market moves. I'm just going to repeat it one more time. Taking buy side or sell side liquidity, aka highs and lows, rebalancing inefficiencies, aka fair value gaps, order blocks, rejection blocks, and rebalance towards equilibrium, aka 50% of the range. Now, onto this checklist here. So first things first, we need a higher time frame draw on liquidity. Draw on liquidity, all these concepts are the same thing, they're just all used in different ways, right? So draw on liquidity is also a fair value gap or also a high and low. But in this case, what we're using it for is to figure out where price is drawing. So if you think about it, logically, if there's a target on the daily chart, right? Say previous day high. All time frames below the daily chart are also going to pull towards that draw. Because if the daily chart is going higher, it doesn't matter how much the 1 minute chart tries to sell, it's going to keep going higher and higher and higher until we reach our level. So what we're going to do, we go into the higher time frames. Why the higher time frames? Because a higher time frame move has to get respected by the lower time frames, because it's within it, you know. The 5 minute chart is within the 1 hour. If the 1 hour is bullish, the 5 minute has to be bullish, you know. Whereas vice versa is not the case. If the 5 minutes bearish, that doesn't mean that if we zoom out and look at the 1 hour chart, it's now bullish. So if we find where price is trying to go on the higher time frames, that's going to give us a good idea of what the lower time frames are doing too, because they are forced to follow the narrative of the higher time frame. So the first thing we're going to do is figure out a higher time frame draw on liquidity, and you're going to get confident in it. I have a video that I made on draw on liquidity, so you guys should also go watch that. But draw on liquidity is something that you gain discretion through time, right? You see certain draws get respected better than others. Like new week opening gap is a great draw on liquidity. It almost always gets has a magnet and gets pulled towards. Whereas, you know, maybe an unfilled 3 minute gap isn't, okay, that's not even a draw on liquidity, but a pretty much closed 4 hour fair value gap isn't going to be as strong, you know. You have to get that discretion. But here's an example of what that's going to look like. Over here, in this side of the curve, when we are bearish and selling downwards, we have previous day low right here. Let me just make sure my mic's on, bro. Hello, yeah, it should be on. Okay. We've got previous day low, bro. MetaTrader better not fucking open now. Got previous day low right here. And this is our obvious draw on liquidity in this example. So once we are respecting bearish, we can expect price to be bearish until this draw on liquidity, right? And let's just pretend that this is London high. And let's just pretend that this is resting inside, you know, maybe a 4 hour fair value gap, say. Okay. Let's just imagine that we've got a 4 hour gap there, and that's London high. So now this London high resting with an unfilled 4 hour gap, that is another beautiful, beautiful draw on liquidity. And I went over draw on liquidity in a lot more detail in my video about the MEC model. So go make sure you've watched that video, because that goes hand in hand with this. And if you guys understand both of this, it's going to be very beneficial to you. But yeah, so here we've got this unfilled 4 hour and London high. And now after sweeping this liquidity here, I'm just going to pretend there's a gap here too. After sweeping this liquidity, we can see now our next draw on liquidity is going to be London high. So from this range here to this range here, we should be bullish and price should be magnetized towards the upside. Meaning what? Doesn't mean that we have to now take a trade all the way from the bottom all the way to the top. But it does mean that we can get our piece of the pie within this zone where we have a confident zone where we know price shouldn't break below this zone. And we know price shouldn't price shouldn't break below this zone before it reaches this zone. So within this leg here, if we position ourselves right, we should be able to take very high probability trades towards that zone. Why? Because again, we know that zone should get hit before this zone, and that's how we're going to use draw on liquidity. Coming back to this, buy side of the curve, sell side of the curve, recognize what program we're in. And that's going to be us with this drawing here again. The market, for those of you guys who don't know this, you guys should go watch ICT's video, and I think specifically the video by, I have to think who it was by, it's, just search MMB or MMXB market maker buy and sell model on Instagram, on YouTube, and I believe maybe Josh Trades, it's maybe Sir Pickle. One of them has a few really good videos on this concept. But basically, it's the theory that if we are delivering and truly displacing, not inside a consolidation market, of course, if we're truly delivering and displacing, it is the idea that market is either in a market maker buy model or a market maker sell model. And that is the algorithm in which that it is currently set. Because as ICT traders, we are looking to capitalize on inefficiencies within the algorithm that the banks and their institutions and whatever use for moving the market and basically making the market. So the idea is that if we look over here, let me just get a little paintbrush. The idea is that from this zone, let's just say here we had swept a key liquidity point. From there down here, this curve is us being inside a market maker sell model. And once sweeping this zone, we then entered a market maker buy model. Oh, that was an ugly ass fucking. We then entered a market maker buy model right there. Okay. And this isn't, again, a very complicated topic, but it is very important for us to know. How can we identify whether we are in a market maker buy model or market maker sell model? Pretty straightforward, but again, very useful. So two things, again, draw on liquidity and which fair value gaps are being disrespected and being respected. So one thing I'm just going to say again for my newer traders, you guys are going to hear all these different words, right? Draw on liquidity, PD array, entry signal, all these things, right? But there's really only 3 or 4 concepts that used within different contexts become different things. Like, for example, how I explained draw on liquidity, liquidity, buy side liquidity. It's all just highs, lows, fair value gaps, and maybe order blocks. That's literally all it is, right? But it's just within different contexts. Like maybe when it's the high of the previous day, then it becomes a draw on liquidity. Or where if it's an unfilled 4-hour gap, then it becomes a draw on liquidity. Or if it's a 1 minute inverse fair value gap after sweeping the zone, then it's an entry signal, you know? But at the end of the day, it's all just fair value gap, high, low. You just need to know the context of it. So don't, when you're hearing all these concepts, don't go, oh, but I don't get this part. And it's literally, you already understand it. You're just going to gain more knowledge of the context so that you know which concepts are what. But it's literally just fair value gap, high, low. Literally all it is. Fair value gaps, highs, lows. And then within different contexts, they become different things. So here, first things first, on this side of the curve, on the sell side, when we are selling, right, we are looking at which fair value gaps are being disrespected. But first, we're going to look at our draw on liquidity. So what did we have in this situation? We had, in this case, say, unfilled 4-hour gap and previous day low right here, okay? That's a strong draw on liquidity. Price is likely to draw towards that. So that's our first confirmation that we are, in fact, likely to be inside of a sell model. Because we are pushing lower and we actually have a target to continue lower. Because we don't just push towards nothing. We're going to push towards something. So that's the first sign. And then secondly, what fair value gaps are we disrespecting? And what fair value gaps are we respecting? So in a sell model, in a market maker sell model, in a bearish market, what are we looking for? We're looking for bearish fair value gaps to be respected, aka tapped into, not closed past, and then traded back out of or used to go lower. We came up into this bearish fair value gap over here, pushed lower, came back into another bearish fair value gap here, didn't close past it, we stayed within it, and then pushed lower. Okay, that is what we are looking for in a market maker sell model, along with us looking what are we doing with the bullish fair value gaps. We are disrespecting them. We made it over here. This is where we made it. I'm going to start it where it was made to not make it confusing. We made it on this move up, and then we closed right through it. Disrespected, right? This gap here was respected, and this gap here was disrespected. Bro, let me make sure I'm not connected to my AirPods or some shit, bro. That'll haunt me. I'm giving away so much sauce here, bro. Disrespected. Bang. And that's exactly how we're going to see if we are in a market maker buy model or a market maker sell model. And when we check out the other side, what happens here now, okay? We respect bearish gap, we disrespect bearish gap. Then we respect bearish gap, and disrespect bullish gap. Then we respect bearish gap and again disrespect the bullish gap right there. But after hitting our draw on liquidity, aka our magnet, along with our suspected reversal point, what happens? We switch. As soon as this moment here happens, the flip gets switched in the algorithm, right? We see now we go from a market maker sell model into a market maker buy model. And how do we see this? By the fact that we now disrespect a bearish fair value gap. Before we had respected, we respect bearish gap, we respect bearish gap. Now after sweeping our suspected reversal point along with our target, meaning let's just say a group of tourists is on a drive somewhere, they driving to Table Mountain, right? They might go a little bit further, they might just drive along Table Mountain Road, but you're trying to guess where they're reversing. So they told you they're gonna go to Table Mountain, then they're gonna go home. So not only did they reach their destination and they have nothing more to go see, but also that's the place where they were likely to say, okay, we've had enough today, let's go back. And that's the exact same thing that that your drawn liquidity is going to do. It's going to be like the final destination for the tour bus, you know? Market was pushing and pushing and pushing, and that was the point where we likely suspect they're going to have had enough. And just based on this alone, that's a whole trade idea, right? Because now what happens? We have this. We have an inverse fair value gap right here. And if you look at this checklist that we've got, when we start getting to entries, we use inversion fair value gaps. But I'm not going to go there yet. But what happens after we switch into a market maker buy model? We disrespect the bearish gap, come lower into a bullish gap, and now we are doing what? Respecting bullish and disrespecting bearish. Simple. We are disrespecting the bearish fair value gaps and we are respecting the bullish fair value gaps. What do we have after that? We come here. We made a new bearish fair value gap on that way down, right? We made this one. Came here and then we close above it. Close through it, disrespecting the gap. Come up here, make another bullish fair value gap. Stay within it, respecting it, and then continuing to our draw on liquidity. And I'm just going to give you guys the example of what's likely to happen next, which is this. Consolidation. After all likely targets of the day, your key draw on liquidity has been hit, the chances are that price is not going to deliver much further and it's going to consolidate. Because what does a candle do? It opens, sweeps, pushes, and then it closes. So this is exactly how we're going to figure out what side of the curve we're on. in a market maker buy or sell model, because after checking if these gaps are being respected or disrespected, what did we get? We got a new draw on liquidity, being this here. So now on the way down, we had a clear draw on liquidity, unfilled 4-hour gap, previous day low. We were disrespecting bullish gaps and we were respecting bearish gaps. Clear market maker sell model. And on the other side of the curve, opposite, we had a clear unfilled 4-hour gap and we had London high as our draw on liquidity. And then we had a bearish fair value gap get disrespected, and that was our symbol that we have now switched algorithms, and from there we see us respect bullish gaps, disrespect bearish gap, respect bullish gap, disrespect bearish gap, sweep the draw on liquidity, and then finished for the day. Everybody's gotten their piece of the pie. Everyone's either won money or lost money, and it's done. Now we're going to get back to, where's the fucking checklist? Here we go. Buy side or sell side of the curve, premium, discounted price and time. We've just gone across that. Now we're going to check rejecting high time frame BDRA or point of interest, and then SMT. So we've just gone over the rejection of the high time frame point of interest, which was exactly what I just went over. So now we will be going over the SMT. Just one more time. Here, this would have been your rejection off of the higher time frame PDRA, right? Higher time frame PDRA was the 4-hour fair value gap. That was our rejection off of it. Not this, sorry, but like this move here would have been our rejection off of it, okay? And just for you guys, because Blake does mention the SMT, very, very simple concept, and this is something you're going to combine with this, which is that, say we have two correlated assets, NASDAQ and the S&P 500, okay? We've got this prominent high here in the market. What do we do once high gets swept? We suspect price will reverse. So as we can see, the S&P comes up, sweeps the high and reverses, when NASDAQ comes up and doesn't sweep the high. But what happens is once the correlated asset sweeps the high, we can treat both assets as though they have swept the high. And within a key point of interest, such as a higher time frame fair value gap or at a higher time frame high or low, this is going to be a good indication that price is going away, because not only did one asset sweep and both are reacting to the downside, but the one asset that didn't sweep has so much momentum that it's already going down. It can't really push back higher, and that's a very good confirmation to have along with the other things that we've just discussed, like your inverse fair value gap that we're about to get into, or the rejection of the higher time frame point of interest. But this is SMT for you guys. And now for your entries, stop loss at swing leg, order block, or closure back below inversion. Right? What is this going to look like for us? So we're going to have entries at an IFVG here, and this is now where we start getting into the discretion. I'm going to remove all of these unnecessary gaps now, so if you guys need that, you guys are going to have to skip back in the video. We swept this level, and now we are looking for our inverse fair value gap, as I'm sure you guys already are familiar with. And after sweeping this and inversing the fair value gap, we are going to go long. And this is where the difference in discretion comes out, right? Because in this case, right here, you know, we might go long there, target this high, and stop loss is going to go at this swing low. However, if maybe our inverse fair value gap is all the way down here, and we only can, when we inverse, we're up here, and we are worried that price might push further without retracing, but we also want to be prepared for its retracement. What are we going to do? We can also put our stop loss below the inversion fair value gap, because price is likely to retest it and go higher but not break below it. What else can we do? We can put our stop loss below the order block. So let's just imagine we have the order block right here. our stop loss goes below that. And in this situation, it won't really change much, but there's often situations where the inversion entry is already so high because price has reacted so strongly off of the level already that we can't afford to put our stop loss all the way at the low. Like, for example, I can actually draw a good example of this. What this might look like is this, right? Consolidate. Now we come down here. Now we push up here, right? We have an inverse right there. This is not a feasible and now let's just say we've got that and we have a draw on liquidity over here. This is our draw right now. Pretend it's previous day high. This is not feasible, right? Usually stops go below the low. That is not going to work because remember, draw on liquidity is our what? Our target. That's not going to work. This is simply just not going to work. We can wait for the limit order on the gap. We can wait to a re-entry, but I prefer not to unless it's a 5 or 3 minute gap and it really just is truly a trade that I don't believe is just going to run. I think it must retest that zone, then I will do that. But otherwise, I like to enter. And that is where, in this situation, maybe we put our stops below the gap. And now, look at our risk to reward. It goes from a 1 to 0.5 R to a 1 to 1 R, which starts getting into territory of trades we would actually look to take. Maybe we've got an order block right here. Another possible stop loss there, and maybe we target just through the draw and use the draw as break even. But this is where the beginning of the discretion is going to come in, right? Because we are looking for a higher time frame liquidity sweep, which is right there. Get that here and here. Then we wait for this inversion fair value gap to be filled. And once we inverse, we want to enter. But we might not get it perfect like this, right? Because this is perfect here. This gives us swing low, swing high. We can go break even at this high here. You see, this is literally a textbook. But again, that is not every single day that we will get this. Swing low, sweeps everything, gives us the inverse, stops at the low, target the high for a good draw. This is a perfect setup. But we don't get that every day, and that's where the discretion comes in. We might only be able to get filled here. And then we would like a tighter stop loss, so that's how we're going to use our stops. Below the order blocks, below the inverse fair value gap, and if we can afford to, and hopefully most of the time, at the swing low. And then, what are we going to use? We're going to use take profits at internal draws, meaning 5-minute fair value gaps, 15-minute fair value gaps, 1-hour fair value gaps, and just general liquidity pools where maybe we've got a few different PD arrays lining up, and then equal highs and equal lows. These are all zones that not only is price likely to reverse out of, but also price is likely to draw to them, so they're going to be great targets for us, right? And again, I'm going to go back to this example. See right here. Let's just imagine we had entered out of here. Bang. Right here. We waited for this to get inversed. And then we went long. Actually, I'm going to use our other example. So, first things first, internal draws would be our gaps. So let's just imagine we've got this. We've got a trading leg higher like that. This is where we left the high, okay? If we've got a 15-minute fair value gap, that would be a great target, right? Because in these situations with the discretionary model, the idea is to be able to capitalize on these small inefficiencies where we have a small range where we know price will react from there to there. So this is what our targets are going to look like. You know, we're going to want to target these unfilled 5 or 15 minute gaps, or maybe this high here, you know. And that's again why it's not fixed. There's discretion involved. You have to work with what the market gives you. Maybe there will be a 15 and no 5, or there will be a 5 and no 15. And that's where you've got to use your own discretion. And yeah, boys, that is the model. I'm going to go over examples of it now. And here's obviously the risk management that Blake uses right there. So he will risk 250 to 750 and 150k account, and 0.617 to 2% take profit, $1,000 to $3,000, 2 trades a day, win or lose. A setup minimum. Summary 1 minute, 15 minute, and I think this was just a summary of a few of the time frames that he uses. But without further ado, we're gonna get into some examples of this model. So I'm gonna go to Friday and just remove all these drawings. Replay. Here we go. Okay, so first things first, what side of the curve are we on right now? We look to be in a buy model. We are pushing higher. We have a clear draw on liquidity right there. God, I think that was previous day high or current day high. Yeah, current day high. Nice liquidity and delivery out of a 1 hour fair value gap. So that's an intermediate term high that we've got right there. Okay. So until this point, we're in a buy model, but from there we could suspect us to be in a sell model. On top of that, what do we see here? What are we doing? We are respecting bullish fair value gaps and disrespecting bearish ones. We're closing past these gaps here. This gap is getting closed through, and this gap is not getting closed through. Do we see that? This gap is getting respected and used to go higher, where this gap is getting closed through. Let me just change the opacity back down a little bit on this. Here we go. Okay. So from this zone onwards, up there, we could expect to see a reversal. So what am I going to do? I'm going to wait for us to actually hit the zone. Okay. Pause. Please don't play another candle. Okay. So what do we have here? We hit the zone. On the way up, what did we do? What do we see here? Let me just remove this. We see in this manipulation leg, you can see from here till here, we just expanded very sharply into price. You guys might be wondering why I'm not including this whole leg here, right? But if you look on a 30-second and sometimes a 1 minute chart, you will be able to see the manipulation legs clearly. And we want to see the zone in which price directly distributed into this level. So if I had to zoom in on a 30-second chart, which I don't currently have on TradingView, you would see price moved higher, stopped, and then manipulated. So our highest time frame manipulation leg fair value gap weight that we're waiting to be inversed is going to be this one right here. Okay, there we go. That's going to be our gap. And then from here, we've got our inverse fair value gap. We have our liquidity sweep. We also need a target for our trade. So now I'm going to open the chart and I'm going to see, what do we have? We don't have an unfilled 5-minute gap or an unfilled 15-minute gap. But we have this low here that price is likely to draw towards. So then what do we do here? We can wait until price inverses this gap. Luckily, we already got the inversion. So this is our signal to go short. And we have got all of this low resistance liquidity over here. All of this that we can target. And this low here in this case is going to be our next target for price. But we don't even need all of that. All we're actually looking for is a 1-to-1. That's what I trade. On past XFAs, I technically only trade 1-to-1. And then I also, so let me make sure I'm not on my trader page. Sell 30 contracts, bang. There we go. And that's all we need. Notice again, I waited for price to sweep a level. I waited for us to get our highest time frame, manipulation leg, inverse fair value gap. And now I'm targeting, I'm not even targeting the whole low. I could probably, but I'm literally not even going to target it. I'm going to, actually might do this, put TP here, and then go buy limit, take out. I don't even know how this trade plays out, but this is just how I would play the trade. Might go buy limit 20, there we go. So then we've got a limit order there for partials and full take profit at the lows. Then we can let this trade play out. Okay, so that's TP one hit and for sure break even on that trade. We can see if it displaces all the way to the low that we suspect it will. Doesn't look like it though. Unfortunate, yeah. But we can see exactly, obviously this was not necessary to target all of this liquidity because we had a range where price was moving within, and the risk to reward that I personally trade, that was more than enough for me to get my piece of the pie out. There's a 1 to almost 2R perfectly that came out of that. And again, the more of that checklist you're able to involve, the higher your probabilities are going to get. Because in this situation, I mean, I trade on YM, so SMTs are a little bit more rare, but we didn't get an SMT, and we didn't have a unfilled 5 or 15-minute gap to target. We had this current session low to target, but we didn't have an unfilled 5 or 15-minute. And then let me just see what happens here. And we can see had another very clean trade that ended up playing out a little bit later in the day. And that was more towards the continuation model side. But yeah, that right there is exactly how the discretion model is going to play itself out. We're waiting for a higher time frame pool of liquidity to be swept. We are waiting for a point at which the market maker buy model will likely turn into a market maker sell model. In this case, we weren't actually correct about that. Price didn't have a true reversal. However, it gave us enough because remember, we are either break even or out of the trades by the time price swings back, because again, what did we get towards here? We got a swing back towards equilibrium. And it's unlucky here that we didn't get that full target, because our full target for the trade was actually equilibrium. But that is all good because we got our section of the trade that we needed to. But the more of these concepts that you're going to get, the more your probabilities on the trades are actually going to go up. And then that is exactly where the discretion comes in, because you're going to need to use these concepts to your advantage and kind of figure out which one do you actually have and what can you use. And it's basically a more discretionary mech model, which allows you to compensate for certain aspects of your trade maybe not being there. If the main criteria being what liquidity you swept, did we inverse with volume, and are we displacing towards a strong draw? If those things are there, just because you can't get a perfect fill and your stop can't go below the low doesn't mean you can't be in the trade, you know, and that's where PB's discretion model is very helpful. But yeah, boys, I really hope that that was helpful for you guys. And I'm going to see you guys in the next one. I appreciate everybody who's been popping into these and been supporting me. I'm not going to forget you guys when I'm whooping lamb truck. I'm going to remember each and every one of you. And yeah, boys, I'm going to see you guys in the next one.